Silver is over $62 an ounce. That level brings a year in which the metal has more than doubled in price. It puts the latest 1-month move among the sharpest 2 and 12% of all monthly rises since the late 1960s. And it has pulled the gold to silver ratio to its lowest point in several years. So what's changed and where to next? I spoke to Mike Oliver to find out. Silver is above 6 to reach. What of it? Well, a familiar set of ingredients sits behind the move. There's a market that has been undersupplied for several years, inventories that are tight in some regions and swollen in others, and a renewed belief that the Federal Reserve is nearer to cutting rates than raising them. And on top of that sits a very modern narrative about solar panels, electric vehicles, and data centers that are quietly absorbing more and more silver. But what interests us today is how this short-term picture fits into a much longer structural story. And so to explore that, we spoke to Michael Oliver of Momentum Structural Analysis. Before we fixated on the latest price print, it was worth reminding ourselves what kind of asset we are dealing with. Silver sits in an awkward place. It's a monetary metal that has functioned as money for thousands of years. And yet in the modern economy, it is also treated as an industrial input using electronics, solar panels, and a long list of niche applications. It is most produced as a byproduct of other mining activity, which means supply does not respond neatly to higher prices. And over the past 5 years, analysts have repeatedly highlighted a structural deficit between mine supply and total demand. So in the conversation, Michael begins from that point. He sets out how he thinks about Sil's role in the system, and why, in his view, the current move has the potential to be disorderly rather than incremental. So, Michael, what has surprised you in 20? It's sort of surprised, but not really, the laboriousness of the U.S. stock market, where, it was late 2024, early 2025, it was making highs, NASDAQ 100. That's headline sell-off, and that's what if you're a bear, you do not want to sell off that has a headline attached to it. You want people to be selling, and they can't figure out why is it going down, because if everybody has a headline attached to it, usually it's a trap. Okay, I mean, it's going to go back up again. So sure enough, Trump waved his wand in mid-April after we had a 22% S&P drop pretty fast, March and April. And we got to a level where our report's Momentum Structural Analysis said, okay, we thought the sell-off was going to occur, but right here around 4,800 on the S&P, which again was a 22% drop, it turned and burned back to the upside. Okay, now, and they did it because Trump said, oh, we're going to hold things off for 90 days. So in other words, the headline that took you down, he sort of shoved it aside for a while. And so it's like a bunch of headline chasers. Chase it down, oh, chase it back up. It's like little puppies. Okay, anyway, but that kind of action, and we made marginal new highs, like 10 or 12% in the S&P, and some sectors didn't make new highs. But okay, pardon me for being long-winded. That's the way stock markets top. If you go back to 2000, the dot or the real estate top in 2007, it was a whole year of laborious, boring, can't quite interpret it type action. So nobody was scared, and yet you were topping. But we did the same thing this year. We went up and took out the high we made early in the year, and then we've gone nowhere for about 3 months now, just doing spinning our wheels. That sort of surprised me. Not that they turned back up from the level we expected, but they went and made a new high. But it shouldn't have. It really should not have. So that was, I'd say if there was one surprise this year, that was it. Okay. And I mean, gold and silver, I mean, I'm kind of, everyone's bored of hearing this. This has been such a phenomenal year for both of them. I mean, new highs here in the UK, but obviously new highs in the US as well. What charts, though, would you draw people's attention to that's going on? Now, what I wouldn't do is look at the price charts, because when you punch on your screen gold or silver, and let's say daily or weekly, and you go back a year or so, it's vertical. So you say, golly, I got to get out of that. You got to take my profits. In fact, if you go back for the 50 years that it's been trading gold, legalized it over here, Okay, anyway, you've had 2 major bull markets, each of which, if you measure from the bear low that preceded it to the bull market peak, was an 8-fold gain from the bear low. Multiply bear low times 8, and you did it twice. The 1980 peak and the 2011, they were both 8-fold. We're only 4-fold from our bear low. Our bear low is in 2015 at 1,046. So we're 4,000. Okay. So if you look at your simple price chart, you say, golly, I got to take profits. I'm nervous. It's only begun. Now we think ultimately those old highs, the eightfolds, that was the norm. I mean, you did it twice under conditions that aren't anything like what we're going to face or are facing. So to expect it to go there is no big deal. The issue is it going beyond there? And probably is. So, but there's a more important thing that's going on, 3 separate charts that you can show. And the very first one's on first page of a report we had 2 weekends ago, and it's a simple, almost what you could call an idiot chart. All I do is I divide at the end of every month, and this chart goes back to 2013 when gold was coming down hard. Okay? I plot the end of each month. I divide the price of the front month COMEX future gold into the price of the S&P, and I express it as a percent. Okay? Well, it was coming down hard during that gold bear market. And then for 11 years, gold has done this on that chart relative to the S&P, meaning it's had rallies against the S&P. It's sold off against the S&P, but it's gone sideways. Few people realize that for 11 years, gold has really been a par performer to the S&P, not been a loser, not necessarily a winner. Sometimes it is, sometimes it's a loser relative. But basically for 11 years, it was like sideways action, oscillating. We broke out of that massive range as of November. Now what does that chart tell you? Anybody with a crayon could draw the green line we've got on that chart and say, my gosh, what a base that is. What stock is that? I'm going to buy it. Okay, well, it's not a stock. It's a relative performance chart. And it's telling you, it's smacking you in the face. Gold is just beginning a major breakout in relative performance to the great US stock market. Okay, so any assumptions otherwise, that chart's screaming at you. No, there's a chart showing the gold miners versus the S&P. Oops, they also broke out in November on a major base pattern relative performance. And silver did too. Wow, so they're all a chorus. They're all saying, hey, we've just broken out against you. So what those charts tell you is it's only just begun. So people that look at a chart and see gold going up for a couple of years say, oh, that's old. No, these charts say the game just began. Anyway, okay, so you kind of answered my next question, but I think, I've been asking people gold in 2026, is it, and the same for silver? No, but gold in 2026, is it more of the same or is it bigger and bolder? It's bigger and bolder, but there's a chart showing silver measured against the gold. And silver has recently, over the last couple of years, in fact, been at very low levels of value compared to the price of an ounce of gold. And so when we plot that chart, you can see it. We just broke out also in November. So in all the first 3 charts I mentioned, gold S&P, gold miners versus the S&P, silver versus all, they said, okay, we've now emerged into outperform status versus the so-called great US stock market. Now, within that monetary metal grouping, silver has broken out versus gold. So it's telling you, yes, you should be in the monetary metals one form or another, but you really should be more in silver. Silver looks like now it's going to beat gold handily and probably in a breathtaking way during this coming year. And I'm betting on a lot of it occurring by the time we get into the second quarter of the year. What happened in November? Why did we start to see these changes across those 3 areas? No, I wouldn't try to find a reason. The reasons exist on a macro level, and they recur, over the past century, especially when we've really gone to fiat money, unbacked currencies printed by governments, where, the value of the currency unit just continues to decay. You say, well, what does it cost in euros, or what does it cost in yen, or what does it cost in dollars? Has my stock gone up? Like it doubled over the decade, let's say. Well, it's the money supply degraded by almost that much, so you're really not making money. Okay, this process has been ongoing for like 100 years now. So one long human lifetime, and that's about how long the Fed's been around. Also, this monetary manipulation destroys certain things like people's ability to calculate their budgets. Where are they going to be in a year or 2 in terms of needed income? All these things change, and sometimes they can change more speedily. And that creates, especially when our stock market turns down, that will be an emotional factor, and that We think it's stopping, and I think it's going to turn down hard early next year. Once that occurs, people feel pain, and when they feel pain, they get emotional. In other words, right now, everybody can look at their 401k or their retirement account if they've got one and they're near retirement, and they say, oh dear, we're okay. We've got, X amount in our retirement account, it's set. If suddenly 20 away, it doesn't come back. Then they look around the horizon and they don't see anything that makes them feel good. Therefore, emotion hits. That's when you enter periods where political upheaval can occur, where people get powed at their governments and they even get in the streets. We've seen this through the West world, and where events happen that even governments can't explain and try to push away. I'll give you a recent example here in the US. The head of the Fed in New York, guy named Williams, about early last month, said that the Fed's going to need to start buying bonds. Quote, bonds. Okay, what for? I thought everything was okay. Hey, guy, and he said, oh no, it's just the liquidity. Not that something's really wrong with the US government debt market, it's just liquidity. We need to provide more liquidity. Well, that's a sign of panic on their part, and they never phrase it that way. But you got to watch these big assets like the UST bonds, because a lot of people have viewed them as an alternative. Hey, I don't like stocks and go over T-bonds. Well, the 60-40 principle is very popular. That's come into doubt lately. I think it was even Goldman Sachs put out a statement saying, hey, it needs to be 60-20-20, 20% being gold. So anyway, these kind of changes occur, and they're massive, and they're everywhere. They're not just one issue. It's not just tariffs, which is really a new issue. And yet gold's been going up for, since 2015. What do you anticipate the tariff problem? No, that's not the issue. It's the ongoing degradation of a core of the economy called the money unit. And, you mentioned there, you think, we're going to see some of these quite significant structural changes shifting towards the end of the second quarter next year. And you also mentioned people on the ground, people who are looking at their 401ks because they're going to start feeling this. But at the moment, when we're looking at from a retail point of view, in terms of gold and silver demand, very, very small demand. They're not playing a huge role in this market. No, particularly. So what's the argument then that wouldn't be delayed somewhat? I mean, is it just going to take a couple of courses to get retail into it, or do you think that something else is going to shift the guess? I think the stock market breakage will cause the emotional wave because not much else is doing well. Like T-bonds, for example, they're not behaving well at all. It looks like if you buy them, you could get flushed, meaning higher yields, lower price. In fact, the recent downside action in the US government 30-year T-bonds don't look good to us. You drop another about 3 points in that market price-wise, and you could see the bot come out, and hence a panic on the part of the central bank. And these type of things will create events. They're embedded in the errors that are built into these markets. So if the US stock market is a bubble, which we argue it is beyond any bubble, we've seen in terms of years of gain, percentage gain, it beats 29, it beats 1973 when we crashed into 74, et cetera, et cetera. It beats them all in terms of longevity and error of pricing. And when you say, well, it's because a good, strong economy. Yeah, right. Look at an M2 chart, money supply. It's like an upward curving arc. And look at Fed funds. They're control the short end of the market. Fed fund rate got up to like 5% recently. And people said, look, they raised that as one of the lower levels of the last 75 years. It's like in the lower quadrant of interest rate levels going back. So even that rate rise from 0 in 10 of the 15 years was it we've had free money. So if you remember Cheech and Chong, the drug guys, this is a Cheech and Chong market. It's been drug fed by the central bank, and therefore they've made errors. People have made errors, personal errors, investment errors. Companies have made errors based on what assumptions about the price of money. And anyway, so when all those errors were plunged out of the system, pain will occur in the street type pain like we had in 2008-9. And that's when central banks go berserk even more so than they already are. Remember, back in 2008, Bernanke did QE print. Stock market continued down for 6 more months. Gold exploded. That's the kind of environment we're in. It's not one issue, it's multiple. They're all just coming together. Yeah. Good question. And I want to just go back to something else you were just talking about. Silver is, I mean, we're seeing this, but it's going to continue to outperform gold, as it were. And what I mean, how will that develop as we move on? We're already seeing quite a dramatic shift in how countries are treating silver. Yeah, silver is both a monetary metal for thousands of years, like gold. In fact, India is moving toward monetizing silver now. But it's also very undervalued to gold. If you go back like the last 50 years, we're trading in the US of gold, and measure silver versus silver in 20 of those 50 years was at least up to 2% of the price of an ounce of gold. Okay. Right now we're okay, very low. But in bull years, like in 79 and 80, when silver went up to the top of that old range, $50 highs, and in 2010, 11, when it went up to 50, it got up 6.5% price of gold and 3.5% of the price of gold. Right now we're 1.4. We're in a bull market. If silver goes and does what it did back then, you could see it double to triple its value relative to gold. So if gold goes up another 50% silver, off the page. Another feature, we ran a bunch of charts a few months ago showing long-term price of copper and lead, exciting metals, right? Okay. And they were in a range, or price range, a boring range bound thing from the 70s, 80s, 90s into about 205 for copper to about 30, 40 years in a range either side of about $50 or whatever. It broke out in, I think it was mid 2005, and in a matter of a couple quarters, it quadrupled in price by 206. Well, you say what excuse really wasn't one. A year or so later, LED did the same thing. And when it moved out of the old reality to a new one, it quadrupled. Why can't silver do the same? If it did, it'd be $200. And that's something you would end of Q2 next year. We expect silver to do the same thing that copper and lead. And I could find other markets that did this as well, where a market has been underpriced for a vast period of time, and it finally says, I made a mistake. And it corrects the mistake by going to a new reality. Rarely does it do it incrementally. It does it in a tantrum. That's what those metals did in other markets as well. Silver never did it. Why? Gold's made higher highs over the past 50 years, major higher highs than the prior bull, and yet silver's been capped in a box. Well, there's an argument, and there's validity to it, that it's been controlled, quote unquote, by from above banks, maybe in collusion with the central bank. I don't care. It doesn't matter. They can't ultimately control reality. And if they've restrained it artificially too long, they've compressed the bomb even more. Yeah, so when it explodes, it even has more of a tantrum. You get in its way, it'll bury you. I'm expecting to see silver because of the spread breakout versus gold, because of the monetary metals breakout versus the stock market. Those all indicate shifts in assets from one category to another. In this case, more into silver than gold, especially noticeable this year since April. Huge gain. Okay. Once you start to break out, and we've now emerged where today, as we're talking, it hit 60 in the US first time. Big deal. That's only, $10 above the top of that 50-year range. I'm arguing that you're likely in the next 6 months or a couple quarters, give or take, see silver have a tantrum. And don't be shocked, because if you go back and measure, like silver in 1980 was 50. Okay, silver in 2011 was 50. Okay, let's deflate. Let's take the money aspect out of that. What's the degradation in the US dollar in terms of quantity per decade growth? Okay, silver would be $200, 300 or 400 easily, just to match those highs. Don't expect it to occur incrementally anyway. Well, they will be, and when events like stock market downturns plus the associated data negativity points that occur, all of a sudden unemployment just doesn't inch up. It shoots up. Factories shut down, etc. You name it. All these metrics that the central banks like to assume, or licenses to kill, they can do what they want now. Okay, they'll do it, in which case the increase in the monetary degradation will even more accelerate as they panic. And the beneficiary of that has always been what? Gold, period. Okay, it always holds its value against degrading money units. So, the stock market rolling over is an assist. Gold's already done this without the stock market rolling over. But when it does roll over in a serious way, gold will have a huge fuel injection. Having this conversation with somebody else earlier on, because I was saying it's kind of crazy. I mean, every time there's a playbook for this, right? And every year, we kind of it feels like the government produced something else. They're suddenly supporting stable coins. We've got the Genius Act or more QE or don't hide and don't hide in crypto. By the way, go ahead. No, 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 no. But they are constantly coming up with enabled primarily by technology with new ways of sort of trying to keep the can being kicked down the road. But there's nothing new here that's going on. No, it's built up error over and over. Even Jamie Dimon, JP Morgan said regarding US debt market, which is bigger than the US stock market. So watch it, okay? This game of government debt rising relative to GDP, and it's like a cyclical thing, goes on for 100 years now. He said you can't keep doing that. Finally, there's a point at which the error has to be dealt with or has the consequences. And there's no sense right now that there's going to be any corrective process on the part of government. Trump wants to, he advocates, he's a free market guy, yet he wants to print, he's telling the Fed to print. He wants a guy in there, take rates to zero or whatever he wants, Well, this is just more of the same. It's not going to work. It's going to blow up in his face. And so there's no solution from within and within governments, UK, Europe, Japan. No, they just want to print. In fact, that's what the new Japanese prime minister said. She sort of is situated herself like she's sort of the Trump of Japan. That's what she thought. But she said, given the debt problem they have there, government, that we're going to quote print. She used those words. If you own gold, smile, okay, because you're protected. So if you already own physical silver, this may just be some kind of moment to revisit your assumptions and make sure that your holdings fit your risk tolerance and time horizon. But if you do not yet own gold and silver and would like to understand how to go about doing that safely, well, why not click on the link below and book a free strategy session now? And of course, our thanks go to Michael Oliver of Momentum Structural and Analysis for speaking with me and for sharing his work with